ever found yourself just, sifting through countless articles, maybe scrolling through endless financial feeds online and feeling a little overwhelmed by all the conflicting advice out there, wondering where your hard-earned money should really go to work for you? Well, if that sounds familiar, you are absolutely in the right place today. Welcome to the Deep Dive. Our mission today is to cut through all that noise. We've taken a whole stack of sources, really tailored them for you, the curious learner, and we're going to unpack the most important, maybe surprising, and truly actionable insights on financial planning and investment. Now, when we say investment, your mind probably jumps straight to stocks, bonds, maybe crypto even. But what if I told you our sources hint at a truly surprising best investment you can make? One that actually goes, far beyond traditional finance.
Yeah, that's a crucial point that comes up right at the start. A powerful, almost counterintuitive claim. The single best investment you can possibly make is actually in yourself.
Investing in yourself. Okay, that sounds good. Maybe a bit abstract, though, when we're talking dollars and cents financial planning.
Yeah.
Could you give us a more tangible example?
Yeah.
How does that translate into, real financial value down the line?
Oh, it absolutely does. It's about generating ongoing value income opportunities. So think things like professional education, developing new skills, pursuing hobbies that can maybe turn into a side business, even just focusing on personal well-being counts.
Okay.
The idea is that improving yourself this way makes you a kind of walking, talking annuity for your future. It can seriously boost your earning potential, your job security, and even improve your health and longevity in retirement. I mean, think about it. Studies show engaging activities like reading, brain games, they can help mitigate things like Alzheimer's.
Right.
Which, financially speaking, could mean lower healthcare costs later and just, a longer period of healthy living.
That's a really powerful way to look at it. It broadens the whole definition of investment. And speaking of broadening the view, our sources say not all worthwhile investments are, financial products sold by licensed pros.
Yeah.
So what are these surprising alternatives, things we might not typically think of?
Exactly. We're talking about things like fine art, collectibles, scientific stuff, historic items, even things like canceled stock certificates, tangible assets. These can be personally enriching, sure, but also become surprisingly valuable. For instance, one author mentions collecting old securities, maps, business memorabilia. Spent maybe $1,000 between 1990 and 98. Today, that collection's worth $20,000 or more. Still held mostly for sentimental value, but still.
That's amazing. A passion project turning into a real asset.
Definitely. Or another example, the author's father-in-law. He bought 37 acres of timberland back in 1958. Cost him just $5,000.
Wow.
They enjoyed it for decades. Got tax benefits, timber revenue, and then eventually sold it for $1,125,000.
Incredible.
And one more, Uncle Buddy. Bought a Buck Knives franchise in '65 for about $8,000. That business ended up paying for his house in San Diego, college for 4 kids, and most of his retirement.
So the big takeaway for you listening, it seems to be about recognizing value in, unexpected places, and understanding how all these different assets, traditional, unconventional, they can all contribute to your overall wealth and well-being. It's a much more holistic view.
Absolutely. Those stories really shine a light on where wealth can be built unexpectedly. But, as we think about building and protecting any kind of wealth, our sources immediately pivot to what's really the bedrock of sound financial strategy, managing risk. And one of the biggest dangers highlighted is something called concentration risk.
Concentration risk, meaning too much in one thing.
Exactly. Too much of your wealth tied up in one single holding. Could be a big chunk of employer stock, maybe a family farm. These might have sentimental value, of course, but that emotional attachment to, say, inherited assets can be really dangerous financially.
Yeah. There's a story about a woman named Jennifer. After her husband, Ray, a retired CFO, passed away in 2008, she inherited this portfolio heavily concentrated in one bank's stock.
Okay.
Now, Ray had been a smart investor, but even his own portfolio trailed the benchmarks after taxes. And critically, he didn't have life or long-term care insurance. So Jennifer's emotional tie to that bank stock, plus no long-term care coverage. Well, over the next 8 years, she eventually ran through all her assets, ended up qualifying for Medicaid.
Wow. That really drives home the danger, doesn't it? Letting sentiment override sound financial decisions, a tough lesson.
It truly is, and it leads us straight into the core principles of diversification and asset allocation.
Right. The basics, but absolutely crucial. Crucial. Diversification is about spreading investments across different asset types to lower risk. Asset allocation is how you strategically distribute those investments based on your goals. And what's key here is the time horizon. Different goals need different timelines.
Like saving for college versus saving for retirement.
Exactly. College funds, you need them sooner, so typically less risk. Retirement funds, longer horizon, you can often afford to take on a bit more risk. Both human advisors and robo-planning software model this stuff. They aim for an 80% or better likelihood of success, basically. The chance your funds will last as long as you need them.
Okay, now our sources bring up something really interesting, maybe even counterintuitive, about investing new savings. Something many of us probably aren't doing. Sounds like a game changer.
Yes, this is a key insight. The recommendation is to invest your new savings contributions, the money coming out of each paycheck, much more aggressively than your existing lump sum.
More aggressively? Why is that?
Well, because these new contributions are smaller, they're periodic, there's relatively little at risk each time, and not for very long before the next contribution comes in. It lets you buy more shares when prices are low, which lowers your average cost over time. It's kind of like dollar cost averaging on steroids.
Okay, so you average down your cost basis more effectively.
Right. Meanwhile, your existing larger balances the money you really need to protect that stays in the more diversified model recommended allocation. Then you just rebalance those existing funds quarterly to keep them on track.
That sounds incredibly powerful. But if it works so well, why don't more firms suggest it? Is there a catch or some hidden risk we should know about?
Well, the main reason firms often shy away from it is, frankly, their software usually cannot model it easily. Plus, they worry about liability if clients forget the crucial step, rebalancing only the existing funds each quarter. And picking aggressive funds consistently can be tough.
Ah, okay. So it requires discipline from the investor.
It does, but the sources stress that if you apply it diligently, this technique will almost certainly amplify your return without added risk to your main established portfolio. The risk isn't really in the strategy itself, it's more in, not following through consistently. So, moving from those sort of overarching strategies, let's zoom in now. How do these principles apply to a very specific and let's face it, daunting goal?
Funding college?
Yeah, college funding. An important point here is the value you can get from paying a specialist maybe a few $100s.
A specialist? For what exactly?
To help identify all the potential funding sources, not just savings plans. We're talking academic scholarships, sports scholarships, even race and gender favoring scholarships, plus military incentives, National Guard, reserves, active service. These things change depending on budgets and politics, so expert guidance is really key.
That makes sense. Getting help navigating that maze.
Yeah.
And when it comes to savings tools, our sources point strongly toward Section 529 plans. What are those exactly? How do they work?
Right. 529 plans. They're state-sponsored, generally low-cost investment accounts designed specifically for education expenses, usually two main types. Prepaid tuition plans, great discounts if you stay in state, but maybe limited if your kid goes out of state or to a private school.
Okay.
And the other is a savings plan. More flexible, lets you invest in mutual funds. State plans often have lower fees. Private plans might offer more investment choices.
So maybe splitting between them could work.
That can be a good strategy, yeah. Splitting the money. And remember, anyone can contribute, but only the account custodian gets the tax benefits, state and federal. You can even change the beneficiary later, maybe to another child or even yourself or your spouse if plans change.
Flexible.
Very. Just be aware, if you take money out for non-qualified expenses, it's penalized kind of like an early IRA withdrawal. Though, interestingly, housing expenses are now qualified. And thinking creatively. Some sources mention buying a condo near the college for your child, maybe renting out rooms, can be an excellent strategy if you have the funds and, crucially, are prepared for landlord duties.
Huh? Yeah, being a landlord isn't for everyone. Definitely thinking outside the box. But what about more traditional financial products? Life insurance for college. Annuities.
The sources are pretty clear here. Using life insurance loans should be a last resort. Big risk, the policy could lapse, and then any tax-deferred gains become taxable suddenly.
Ouch.
And a very explicit warning. Never use annuities for this. Annuities just aren't built for it. They don't allow loans. They're designed for long-term, crucially important retirement income guarantees.
Got it. Wrong tool for the job.
Exactly. And always, Always remember, FAFSA, the free application for federal student aid. That's your starting point for federal grants and loans. Don't skip that. So all this discussion about specific goals like college naturally leads us into the deeper waters of portfolio management itself, where the details and the metrics really start to matter. Yeah. What's really fascinating here is how planners, both human and robo, build what they call efficient portfolios.
Efficient portfolios.
Yeah, they use these huge historical databases, tracking how different asset classes, stocks, bonds, real estate, commodities, etc., behave in all sorts of economic weather. The goal is to find that specific mix of assets that hits your target return with the least possible volatility or risk. It's often visualized as the efficient frontier curve, finding that sweet spot.
Okay, the efficient frontier. That sounds powerful conceptually. But how do we go from theory to reality? How do we actually test if our plan, our portfolio, is likely to hold up in the real messy world?
Great question. That's precisely where the Monte Carlo simulation comes into play.
Monte Carlo sounds like gambling.
A little, maybe. But it's sophisticated financial modeling. It runs thousands, literally thousands of randomized economic scenarios, booms, busts, inflation spikes, you name it. And it calculates a % likelihood of success. Basically, the probability that your portfolio will meet your financial goals without running out of money. Personally, as an expert looking at these, anything under 90% likelihood starts to feel problematic. If it's lower, you really need to think about adjustments. Spending less, saving more, maybe tweaking the asset allocation. It's essentially a financial stress test.
A stress test. I like that. Makes sense.
And this brings up that age-old debate. Active versus passive management. Should you pay someone to actively pick stocks or just buy index funds?
Right. The eternal question.
Well, lots of studies, as you know, decry active management. They argue the fees often eat up any alpha, that's the extra return you get above a benchmark, adjusted for risk and fees. However, our sources point out something important. Active managers do often beat their benchmarks before you factor in their fees.
Before fees. That's the kicker.
It often is. But alpha can still be found, especially in, let's say, more aggressive or volatile asset classes. Think high-yield bonds, small-cap stocks, maybe strategies using derivatives, those complex instruments pros use. So a strategic approach might be, if your portfolio is large enough, maybe $100,000 minimum, for a really aggressive manager, use active management for the riskier upper end of your portfolio, and then stick with index funds or just buying and holding individual stocks or bonds for the more conservative, lower end.
Kind of a hybrid approach, though.
Exactly. Best of both worlds, potentially. Now, choosing a brokerage. Generally, large established firms are recommended. They have good research, wide range of products. But, and this is a big but a crucial warning from our sources, always beware of the brokerage's own brand products and those of their subsidiaries.
Conflicts of interest.
Precisely. There have been huge fines against major firms for, well, breaching their fiduciary duty, pushing their own stuff even when it wasn't best for the client. So be aware.
Okay, so as you're looking at different investment options, what should you be focusing on beyond just the advertised returns? What are the key things to look for?
Right. You absolutely need to understand the risk you're taking. Don't just look at the return number. Think about beta first.
Beta?
Beta tells you how much an investment tends to swing compared to the overall market, like the S&P 500. A beta over 1.0 means it's more volatile than the market. Is the extra return, the alpha, worth that extra bumpiness?
Okay. Volatility relative to market.
Then there's standard deviation. This measures the total volatility, how much the returns jump around their average. Lower standard deviation generally means more consistent, predictable performance, less surprises.
Consistency, got it.
But for my money, the Sharpe ratio is probably the best measure of a manager's likelihood of future success.
Sharpe ratio. Why is that the best?
Because it directly measures risk-adjusted return. It takes the return above a risk-free rate, like a treasury bill, and divides it by the standard deviation, the volatility. A higher Sharpe ratio means you're getting more return for each unit of risk you take on. That's what smart investing is all about. Always look at several years of history for that ratio, not just one good year.
More return for the risk. Makes perfect sense.
And never forget that landmark study, Brinson, Hood, and B. Bauer, 1986. It found that a stunning 93.6% of your portfolio's return comes down to asset class allocation.
Over 93%. So it's not about picking the absolute best fund manager.
Largely, no. It's about getting the big picture right. How much in stocks, how much in bonds, real estate, etc. That foundational mix drives almost all your long-term results. Specific manager selection is secondary.
That's fundamental.
Absolutely. And always the disclaimer. Past performance doesn't guarantee future results. For assets over, say, $100,000, our sources really justify getting that more expensive analysis, the kind that includes Monte Carlo simulations and uses constantly updated databases to fine-tune that crucial asset allocation. Okay, let's dive into some specific investment products now, and maybe more importantly, how to sidestep some common traps.
Yeah, let's talk specifics. Annuities first. We touched on them briefly.
Right, annuities. Variable annuities, VAs, some, like the Prudential HD Lifetime series mentioned in sources, have impressive features. Outstanding money managers, unique income guarantees like a highest daily value lock-in. But there are often 3 catches people aren't told up front.
Oh, catches.
Yeah. First, the investment management inside the VA might be a cloned, less aggressive version of the retail fund with the same name. Second, activating an income rider often dampens that aggressiveness even further. And third, the actual income percentage you get might be lower than you expect. Also, know that carriers can technically remove those income riders later. Lots of fine print there.
Definitely. Then you have equity indexed annuities, EIAs, and their life insurance cousins, EIULs, famous for guaranteeing no market loss. Your interest is linked to an index like the S&P 500, but with caps limiting your maximum gain and participation rates, meaning you only get a percentage of the index's rise.
So principal protection, but limited upside.
Exactly. The way they guarantee no loss involves some clever financial engineering with options, but for you, the investor, the key is understanding those caps and participation rates are the trade-off for safety.
This brings up a critical point then. Given these caps and rates and different ways interest can be calculated, what's the secret? How do you pick the right crediting method for an EIA?
That's a good question. Choosing the crediting method like annual point-to-point, a monthly point-to-point, or monthly averaging really depends on what you predict the market will do. Is it going to be volatile with decent average growth? Maybe annual point-to-point, calm, steady growth. Monthly might capture it better. Growth followed by a dip. Averaging could smooth it out.
So it depends on your market outlook. It really does. It's something to discuss carefully with a professional. But always remember, annuities are long-term retirement tools. Not for college, not for short-term goals. Their core value is that long-term guarantee of income.
Okay. What about life insurance as an investment?
Generally, think of it as purely a tax management and retirement planning strategy. It's one of the few remaining true tax shelters, yes, but really only makes sense if you have a genuine lifelong need for that insurance coverage itself.
Got it. Need-based, primarily. Real estate.
Real estate definitely helps diversify a portfolio, but the sources strongly caution against managing your own rental properties directly.
We touched on this, the hassle factor.
Big time. It's extremely demanding. Risks of violent tenants, potential lawsuits. The author even shares being sued by a renter once. Another client lost $20,000 trying to flip houses, bad contractors, bad tenants, nightmare stuff.
Wow, yeah. It sounds like those TV flipping shows leave out a lot of the messy reality. Maybe needing a lawyer on speed dial.
They certainly do. The recommendation: own investment real estate through composite investments like mutual funds or exchange-traded REITs. Or, if you must own directly, hire a qualified property manager. Let them handle the headaches.
Okay, so REITs, real estate investment trusts. You mentioned exchange-traded ones are better. Why the caution generally?
Yeah, REITs offer a way in, but historically many traditional privately offered REITs were problematic. They lacked transparent market pricing. You didn't really know what they were worth day to day.
Unlike stocks or exchange-traded funds.
Exactly. This led to false assumptions about value. Exchange-traded REITs solved that transparency issue because they trade on public markets like stocks.
Now, here's another story from the sources that really highlights a critical deception to watch out for. The really tragic case of Mark and his son.
That's a tough one. Mark's son worked for a private REIT company. He sold his own father a REIT product. The problem was the distribution rate, the payout, was presented as if it were investment return, like yield. But it was actually being paid from new investor money.
Basically a Ponzi scheme.
Essentially, yes. It collapsed, and the financial and emotional fallout for Mark was devastating. A terrible situation.
A stark warning.
Absolutely, it underscores. Be highly wary of distribution rates that seem too good to be true, and generally avoid direct REITs unless they are exchange traded.
Okay, what other high-risk things should people just steer clear of?
Well, the sources are pretty blunt. Buying new timeshares is usually a bad deal. The assumptions are all wrong. If you really want one, buy used online, you'll find dramatically better deals from people who overpaid buying new and just want out.
Good tip.
And then there's a whole list. Penny stocks, super volatile, easily manipulated, complex derivatives, trying to day trade or short sell, even direct precious metals investing or options trading, unless it's done defensively with expert guidance.
So leave the risky stuff to the pros.
Pretty much. Let the pros do what the pros do. You focus on composite investments like managed accounts, mutual funds, exchange-traded funds, annuities, and other well-regulated and fair market-valued assets. Oh, and avoid margin borrowings from your brokerage. It puts a lien on your entire account, and you risk a margin call, forced selling at the worst time. Sounds closer to lottery tickets than prudent investing.
Yeah, margin calls sound terrifying. Okay, shifting gears a bit, this next insight is fascinating. Can we actually predict the future? When it comes to the economy, the markets, is there any reliable pattern?
Well, perfect prediction is, of course, impossible, but our sources highlight some really groundbreaking work by economists Harry S. Dent Jr. and James V. Smith Jr. They identified what they call the demographic factor or the spending wave.
Spending wave.
Yeah. It's based on the idea that people's spending habits change predictably throughout their lives, peaking around age 49, give or take 5 years. This creates a powerful, almost causal effect on economic booms and busts, corporate profits, overall spending, and even stock prices. And because it's tied to birth rates, its influence is somewhat predictable 50 years into the future.
50 years? That's incredible.
It is. Now, according to their models, this factor has actually been a negative leading indicator since around 2010. It was predicted to bottom out in 2022, followed by a potential 19-year upswing.
A 19-year upswing. Wow. But is it foolproof?
No, that's the crucial caveat. While it's a profound long-term force, this demographic factor can be overcome by other adequately strong factors. Think big events like 9/11 or the 2008 credit crisis. They can overwhelm the demographic trend temporarily.
So not a perfect crystal ball, but a powerful long-term lens.
Exactly. So what does it mean for you? It suggests maybe leaning towards growth, go for growth, but also perhaps diversify more into low-risk asset classes than the standard models may recommend, just in case. And definitely focus on reducing debt, being ready career-wise, asset allocation-wise, and making sure you have adequate cash reserves. Prepare for opportunity, but also for potential bumps.
Sound advice, regardless of the prediction.
Uh-huh.
Okay, finally, let's talk about the investor's own mind. Psychology. How do we avoid being our own worst enemy?
Oh, investor psychology is huge. The sources strongly advise. Avoid checking balances frequently. You'll only torture yourself. Constantly watching the market ups and downs just leads to emotional decisions. Also, try to tune out the noise. Avoid too many sensational commercials or those too gloomy or too exuberant financial articles. Find balanced sources.
So what does this mean for you when the market inevitably takes a nosedive? Should you panic? Sell everything?
Absolutely not panic, and be careful of the what goes down must come back soon fallacy. Sometimes recessions or downturns last longer than we hope. Instead, if there's real evidence that there is a significant chance of loss based on sound analysis, not fear the recommendation is strategic selling, if necessary. Maybe never sell out more than a third initially. If the downside risk persists, maybe sell another third of the remainder, incrementally.
A measured approach.
Exactly. Crucially, avoid the panic sellout, but also avoid the greedy grab. Don't chase every market upswing or make overly aggressive plays based on euphoria. Stay calm, stay measured.
Wow. Okay. From realizing the true value of investing in yourself, all the way through complex products like annuities and REITs, understanding risk metrics, and even long-term demographic trends, we have covered a ton of ground today. You, listening, are now really equipped with knowledge that goes way beyond the typical surface-level advice. And maybe the final thought is this. Understanding that true wealth isn't just about the numbers flickering on a screen, but maybe it's about the depth of your knowledge, the strength of your personal resilience. That's a kind of return that keeps paying dividends year after year, wouldn't you agree?